Hi, everyone. Okay, so let's start the unit on bank reconciliations. Before I jump right into bank recs, as they're often known, let's talk a little bit about banking. Okay, so banking is a type of control for an organization so that they can protect their cash. And this is done by using bank accounts, bank deposits, and checks. And they all help to safeguard cash. So a bank account, I'm sure everyone in this course has a bank account, okay? But how many of you have actually used checks on your bank account? And for businesses that still write checks, because as you know, a lot of them do the electronic funds transfer instead of doing checks anymore. But a lot of times to help strengthen the control over checks being used, each check that was written actually needed two signatures instead of just one. And a lot of times companies have more than one bank account. You might have more than one bank account. Maybe you have a regular daily checking account or a daily account, and then you have a savings account as well, one that might actually collect a little bit of interest. Well, companies a lot of times have separate bank accounts for, say, for wages to pay their employees. Okay. So a bank deposit slip, as you can see here, pause the video if you want to get a closer look. But as you can see, when we go to deposit into the bank, so if a company brings all of its cash and its checks inside the bank to a teller, or even drops it off in the night deposit slot. So if you go to an actual bank and you see outside a metal drawer, that's where companies can open the drawer and put in a night deposit bag. And it actually has a really big zipper on it. It's thick material and it locks. And the company would have a key and the bank would have a key. So if a deposit is being made, say, after banking hours, this is where the company or the person dropping the deposit off would put the deposit, okay? And they would fill out a deposit slip. So as you can see here, any check that's included in the deposit is written out with the amount and the total, and then the total is carried over to the main page on the deposit slip with the cash, and then it's saying what the total deposit is. And the deposit can have bills, coins, and checks. Okay, so checks. So some of you may never have seen a check before. I know years ago, and it's been a few years now, that employers have started doing direct deposits into bank accounts and are no longer providing checks on payday. So checks, as I mentioned before, a lot of times companies needed two signatures. So instead of just one line there with the signature on it, there'd actually be two lines. So they'd have to have two signatures, two signing authorities that were approved by the bank. Okay. I think everybody's probably familiar with electronic funds transfers, and this can happen for deposits coming in as well as making payments going out. Credit card transactions, okay, so Visa, MasterCard, American Express, and a lot of times when we pay by credit card, and we, the customers, a lot of times are enticed to use credit cards because of the different point options that are given to us, whether it's travel points, whether it's scene points, whether it's getting money back at the end of the year. But if we pay by a credit card, it's actually costing the company that we're purchasing from, it's actually costing them money. They have to pay a fee for every time um, a bill is paid by a credit card with them. So as you can see here, so say I purchased something from a company for $100 and I gave them my credit card. The credit card company might only give them $96, but the company has to record the fee that the credit card company is charging them. So then it would go to credit card expense or credit card fee expense, as you can see here up at the top. Debit cards. As you know, debit cards are very similar to credit cards, except it's not creating debt. It's actually taking money out directly out of your day-to-day bank account. But again, a lot of times a company is being charged for using the card. So if I, again, purchase something from a company for $100 and I pay using my credit card, well, maybe the bank will give them $99.60 and the charge will only be 40 cents instead of, as we saw over here, $4. And that's why a lot of times smaller businesses don't like to take credit cards and only take debit cards, or maybe they only take MasterCard instead of Visa because MasterCard is a better rate. Maybe they get $98 instead of only $96. I'm not sure if any of you use this, and I don't. I've never tried it, where you actually can upload your debit card or your credit card rate onto your phone and use your phone to pay. Um, and then, of course, we have Interac as well, where we can send somebody money. Okay, so now we're getting into bank statements. So every bank statement, even though it may look a little different, and it might help if you went online before watching this portion here, went online and actually called up your own personal bank statement onto your screen and had a look at it. Okay, you're going to notice that there's showing you a balance from the beginning of the month, which would be the ending balance from last month's statement. Then it's going to show any checks or debits decreasing the account during the month, or checks that you wrote or debits that you've created by paying directly from your account, or any deposits coming into your account. And then afterward, it's going to show you the ending balance. Here's a sample, okay? So if you have a look, okay, it's showing checks and debits, and that means what they're talking about there is any checks that you wrote out of your bank account. So let's talk about your bank account for the moment. So any decreases to your account, they're calling them debits. Whereas if you think back to chapter 2, when we were doing the journal entries, any reductions in cash were credits. And then here, if you look as well, where it says deposits and credits, so money going into your bank account, they're saying, well, which would be a deposit, you're depositing money in, or your employer has deposited money into your bank account. But for some reason, they're calling them credits. But again, thinking back to the journal entries or our T accounts or our general ledgers, if our cash account is getting bigger, they're debits. So why on a bank statement does it look like it's backwards? Okay. The reason being is because the bank statement is from the bank's point of view. Okay. So when You deposit money into your bank account, or your employer deposits money into your bank account. It's a liability for the bank, right? The bank's holding that money, your money, but they've got to pay it back. It's a liability. They owe you that money. And then for checks, so when you're reducing your bank balance, it's a debit because the liability is getting smaller. So the more money you take out of your bank account, it becomes a debit to reduce the liability. So if you need to, listen to my explanation again, okay? Okay, so again, notice that deposits are called credits and checks or withdrawals out of the bank account are called debits on the bank statement. This is because the bank statement reports information from the bank's point of view. That a depositor's account is a liability on the bank's records since the money belongs to the depositor and not the bank. All right, I'm going to end the video here because the next slide starts talking about bank reconciliations. Thanks, everyone.